They're going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I never felt that I knew it, and I never felt it was important.
They say that good things come to those who wait. Is this really true? Think about it. When you plant a seed, do you expect a tree overnight? Of course not. It takes time, care, and patience to grow into something extraordinary. The same goes for building wealth. Chasing quick profits might seem tempting, but the real success stories come from those who play the long-term game. Today, we'll uncover why focusing on long-term value over short-term gains isn't just smarter, it's the key to lasting financial success. So, are you ready to learn just how important patience is for success? Then stick around till the end of the video.
Stocks are safe for the long run, and they're very unsafe for tomorrow.
Patience is often taught to kids through small, everyday lessons like waiting their turn to speak, sharing toys, or standing in line without fussing. Parents and teachers encourage delayed gratification with activities like setting goals or rewards. Over time, these practices build self-control and an understanding of how waiting can lead to better outcomes. As children grow, patience evolves into a skill they apply to bigger challenges, like studying for exams or working toward personal goals. In adulthood, it manifests in areas like career development, relationships, and even financial planning, which is what we will focus on today. It's the resistance to make impulsive decisions, because that will enable you to reap the long-term benefits. The journey from toddler tantrums to mastering patience is about learning that not every reward is instant, and that good things often take time and effort to achieve. We have all heard the tale of the tortoise and the hare. You probably already know the gist, but it's a perfect example of patience and consistency beating impulsive shortcuts. The hare knew that he was fast and had overconfidence in his ability and mocked the slow tortoise. But instead of staying focused, he gets cocky, takes a nap, and wastes time. Meanwhile, the tortoise just keeps moving, slow and steady. By the time the hare wakes up and tries to catch up, it's too late. The tortoise has crossed the finish line. The lesson to learn here is that it doesn't matter how fast you start. It's all about persistence, patience, and staying on course. Whether it's building wealth, mastering a skill, or achieving long-term goals, those who remain steady often outpace those chasing quick wins. Patience, the key to long-term success. Patience is one of the most underrated tools in investing, yet it's critical for building wealth over time. For example, if you decide to put your money in the stock market, you must know that it's a world of constant ups and downs. No 2 days are the same, and it can test even the steadiest nerves. For example, the S&P 500 has averaged around 10% annual returns over decades, but these gains don't come in a straight line. The S&P 500's annual average return in 2023 was 26.3%, a significant increase from the 18.1% return in 2022. Returns may fluctuate widely yearly, but holding on to investments over time can certainly help. Let's talk about the 2008 financial crisis. From its local peak of 1,300.68 on August 28, 2008, the S&P 500 index plunged nearly 48% in a little over 6 months to its low on March 9, 2009, causing too many people to panic and sell. According to figures, the 2008 crisis wiped out nearly $8 trillion in value from late 2007 and 2009, and Americans lost $9.8 trillion in wealth. The home values plummeted and retirement accounts vaporized. It was a total disaster. While panicking over your hard-earned invested money losing value is natural, it's not wise to give in and sell everything. Those who stayed invested saw it all recover and surge by over 170% by the time it was 2013. This tells you that downturns are temporary, but losses from impulsive selling can be permanent. I mean, think about it. It's true that downturns can come and are devastating to the working class, but the world will move on. Money will continue to be made, and somehow it finds ways to get back its lost value. But that takes time. Patience also leverages the power of compounding, which is your best friend in long-term investing. Take an example. If you invest $1,000 at a 10% annual return, it will grow to over $6,700 in 20 years. But only if you resist the temptation to pull your money out early. It's what the financial gurus do, like Warren Buffett. This man has a net worth of $148 billion and is the world's most famous investor who built his fortune by focusing on long-term value, holding investments like Coca-Cola for decades. During the peak of the 2008 crisis, he invested $5 billion in Goldman Sachs to strengthen the firm's capitalization in turbulent times. That decision of Buffett has generated a return of roughly $3.1 billion for him. He believes in looking for the core fundamentals of a company, and if that's all in shape, it will bounce back once the storm has passed. According to him, the stock market is a device for transferring money from the impatient to the patient. And it's true. Buffett's success stems from staying calm during market turmoil, trusting in his strategies, and letting time do its work. To really cultivate patience, you should start by setting realistic expectations. Understand that market downturns are inevitable, but they're usually followed by recoveries. One important way is to diversify your investments. It can also help reduce anxiety, as it spreads risk across different assets. Even if one investment goes down, the other will keep you afloat. Another strategy is to think like a business owner. If a company's fundamentals are strong, short-term price drops shouldn't scare you off. Apple, for example, lost nearly 60% of its value in 2008. But those who held on to their shares saw it grow by over 1,000% in the following decade, proving the value of long-term thinking. The Elon Musk-backed Tesla also faced significant challenges, nearly collapsing due to cash flow issues. By 2009, the company was down to just $9 million in cash, losing $31.5 million in the process. It was almost at the doorstep of bankruptcy, but one miraculous $50 million investment later, it came back. And now it's more than $1 trillion in value, while Apple is at $3.4 trillion. Resist impulsive decisions. Imagine the stock market dips unexpectedly, and your first instinct screams to sell. This is a classic emotional reaction, and is actually the fear driving your investment decisions. But impulsive moves like this often end up a regret later. Market history shows us that the biggest mistakes happen when emotions replace strategy. Let's explore why resisting impulsive decisions is crucial and how to build this discipline. Why we react impulsively in investing. Investing is as much about psychology as it is about numbers. Fear and greed are two major emotions that drive impulsive decisions. Fear of losing everything fully prompts investors to sell during market downturns, with losses that might have been recovered later. On the flip side, the fear of missing out FOMO can lead to chasing hot stocks or trends without proper analysis, as seen during the cryptocurrency boom and bust. During the 2008 crisis, many investors sold their portfolios in panic, missing out on one of the most significant recoveries in stock market history. Those who stayed invested or even bought more during the low points reaped huge rewards when the market rebounded. The cost of impulsive decisions. Acting impulsively can cost you significantly. Studies suggest that emotional investing, like frequent trading or reacting to market news, can reduce your annual returns by as much as 4% due to missed opportunities and transaction fees. Overconfidence also plays a role. Many investors believe they can outsmart the market, leading to excessive trading and losses. So how can you resist impulsive decisions? 1. Focus on your goals. Remember why you're investing in the first place. Is it for retirement, a child's education, or a house? These goals are long-term, so your strategy should match. Reacting to every market fluctuation pulls you away from these objectives. 2. Automate your strategy. Using tools like automatic investment plans or stop-loss orders can help you stick to your strategy without succumbing to emotional swings. For example, staggered buying and selling can reduce the risk of market timing. We will discuss automation later in the video in detail, so keep watching. 3. Diversify your portfolio. Spread your investments across sectors and asset classes to cushion against downturns. A diversified portfolio doesn't just manage risk, it also gives you the confidence to stay invested, knowing one bad move won't wipe you out. 4. Adopt a long-term view. Markets are inherently volatile, but history shows they recover and grow over time. Warren Buffett advises staying calm during downturns. Be fearful when others are greedy, and greedy when others are fearful. Focusing on the long term helps you see dips as opportunities rather than disasters. 5. Avoid the noise. The 24/7 news cycle amplifies market volatility, making every dip seem catastrophic. Instead of reacting to headlines, base your decisions on solid research and fundamental analysis. 6. Learn from past mistakes. Document your trades and decisions. Reviewing what worked and what didn't can help you identify emotional triggers and avoid repeating them. Reinvest profits. Now, once your investment gains value, it will become your profit. And let's get real for a second. Reinvesting profits might sound like something only big corporations do, but it's one of the best ways to build wealth, whether you're an investor or a small business owner. Reinvesting is all about taking your earnings, whether it's dividends, interest, or the profit from selling an asset, and putting it back into your investments. Why? Because it accelerates your growth. It's like planting seeds and letting them grow into a forest over time. The magic of compounding. The main reason reinvesting is so powerful is compounding. Imagine you invest $10,000 and it earns 7% a year. After a decade, you'd have about $19,672. But if you reinvest your returns each year, that same $10,000 grows closer to $20,000. You're not just making money off your initial investment. You're making money off the money your money made. It's like snowballing your earnings, and the longer you let it roll, the bigger it gets. So why should you put the earned profit back into the grind? 1. Staying ahead of inflation. You know, if you don't reinvest, what happens? Your money is just sitting there losing value over time. $1 today won't buy the same amount of stuff tomorrow because of inflation, but if you reinvest, you can outpace inflation. Reinvesting in growth stocks, real estate, or high-return assets helps you beat inflation and keep your wealth on track. 2. Bigger gains over time. Every time you reinvest, you're increasing your stake in whatever you're invested in, which means bigger returns down the road. Imagine if you had reinvested your profits during the early days of Amazon or Netflix. Those small investments would have multiplied hugely over time. While this is often a long-term game, the results are hard to argue with. 3. Reap the rewards of new opportunities. Let's say a new tech company starts making waves, or a particular stock is hitting new highs. Reinvesting your profits gives you the flexibility to buy into these opportunities and make the most of them. You're not just sitting on your cash, you're actively growing your wealth by taking advantage of new trends. Look at Warren Buffett and his approach to investing. He doesn't spend all the profits. Instead, he reinvests them, making his company and his wealth grow even faster. Berkshire Hathaway's value has skyrocketed because of this simple but powerful strategy. For regular people, reinvesting can also lead to impressive returns. Let's say you receive $500 in dividends from your investments. If you reinvest that $500 into more shares instead of spending it, those shares will earn you even more in the future. Over the years, this strategy can make a huge difference in the value of your portfolio. The roadblocks to reinvesting. Now I get it. Reinvesting isn't always easy. Sometimes you might want to cash out and use that money for a vacation or to buy something fun. But here's the thing. It's all about thinking long-term. You're playing the slow game here, not trying to score quick wins. Also, let's not ignore taxes. When you reinvest profits, you may still be on the hook for taxes depending on the income, but there are tax-advantaged accounts like IRAs or 401ks where reinvesting won't hit you as hard. How to reinvest wisely. You don't have to go crazy with reinvesting. The key is to keep things steady. You can set up automatic reinvestment programs, which will take care of buying more shares for you without you having to lift a finger. Also, be smart about it. Don't just put all your reinvestment money into the same stock or asset. Diversify. Understand value over price. When you're thinking about value over price, it's all about recognizing what a company is truly worth, beyond just its market price. Investors often make the mistake of looking at short-term price changes, which can be influenced by trends, emotions, or temporary conditions. However, understanding intrinsic value means focusing on the long-term stability and fundamentals of a company. Value investing is rooted in this principle. You want to identify companies that are undervalued relative to their actual worth, whether that's based on cash flow, growth potential, or market position. For instance, a stock might look like it's doing poorly in the short term, but if you believe in the company's long-term prospects, then it's worth considering if the stock is priced lower than its true value. Warren Buffett has done it, and his strategy focuses not on whether a company's stock price is high or low, but on its future growth and stability. When Buffett buys stocks, he's thinking decades ahead. valuing businesses based on their capacity to generate consistent earnings. This is what value investing is all about, the patience to wait for the market to realize what you've already understood. So, whether you're investing in stocks, real estate, or even building your own wealth, it's crucial to look past the price tag. If you focus on value, your long-term returns will likely be more stable and rewarding. Keep an eye on what's really driving a company or any investment forward in the long run, and don't get distracted by short-term price fluctuations. If the company has solid core values and fundamentals, it will grow back its worth eventually. How to do it with a busy schedule. Life today is busy, and not everyone has the time to track every dip and spike in the stock market. Whether you're juggling work and family, or just don't want to obsess over market trends, there's good news. You can still invest and reinvest effectively without watching the market 24/7. And here's how. Start with index funds, or ETFs, exchange-traded funds. These investment tools track broad market indexes like the S&P 500, meaning your money is automatically spread across hundreds of companies. Historically, the S&P 500 has averaged about a 10% annual return over decades, as we discussed before, and it's a convenient set-and-forget strategy that works for long-term growth. Automating your investments is another lifesaver. There are reliable platforms available like Vanguard, Fidelity, and robo-advisors such as Betterment and Wealthfront that let you let up automatic contributions and reinvestment plans. The dividends that you earn are reinvested back into your portfolio, which compounds your growth over time without you lifting a finger. The robo-advisors are also great if you want hands-off investing. They use algorithms to manage your portfolio based on your financial goals, risk tolerance, and timeline, and also rebalance your portfolio when needed to keep it aligned with your goals. Then there is dollar cost averaging, which is great if you are concerned about missing opportunities in the market. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. So instead of purchasing shares at a single price point, with dollar cost averaging, you buy in smaller amounts at regular intervals no matter what the price is at that time. This strategy minimizes the risk of buying all at a market high and ensures you're steadily building your portfolio over time. Target date funds are also worth exploring. They work by automatically adjusting the asset allocation over time and slowly shifting from riskier investments like stocks to more conservative investments like bonds as you get closer to your target retirement date. It's like having a built-in financial manager. These strategies can help you be in the game while not stressing over the market's daily chaos all the time. So to wrap things up, let's break down the do's and don'ts of focusing on long-term value. Stay patient. The market will have ups and downs, but sticking to your strategy pays off over time. Don't give in to impulsive decisions. Selling at the first sign of trouble or chasing the latest trend often leads to regret. Reinvest your profits. It's the key to compounding wealth. And always remember, value matters more than price. Focus on investments with strong fundamentals, not just what's cheap or trendy. Think about your future goals: buying a home, sending kids to college, or retiring comfortably. These things take time and money, and a long-term focus gets you there without all the stress. At the end of the day, life is already complicated, so let your money work smarter, not harder, for you. I hope you found the video insightful. If you liked it, please don't leave without pressing the like button and subscribe for more helpful content. Thanks for watching, everybody. See you next time.